Welcome all to the Node. I am Mike, aka Veteran Crypto, and with me as always, Monday through Friday, 9 a.m. Pacific, noon Eastern, is David. How's it going, brother?
Doing well, Mike. Doing really well. Woke up this morning around 5, watched the sunrise, went out to the beach, swam in the ocean, and then had an entire day of work, and now it's noon. So I've been working already for an entire workday, man, and I got a lot of updates to the Node.pro. They are shipping as we speak. So in a couple of minutes here, that community source room, man, big updates going on there.
Nice. Yeah, no, good to see. And I apologize to everybody out there. We're a little bit late going live, like a minute. I'm usually very punctual, but I was on a phone call. So, it's me and my brother and my nephew. We bought an investment property, and we're starting an adventure guide company. So, up here where I'm at, we're going to be doing, kayak tours, hunting, fishing, four-wheelers, snowmobiles. Actually, even we're built out a 3-story building, and basically going to get a bunch of airsoft guns. And basically have like corporate retreats and stuff like that, where people can come up and do team building stuff and do room clearing.
Corporate retreats with people with airsoft guns. So does that mean that if you got like the HR lady, they're going to gang up on the HR lady, man? I think.
Yeah. No, but it just like I said, it's just kind of it's a fun business, but we're definitely it's a serious business, but we. But I'm going to be going over there this weekend because it's just dense forest. And so I got to go through and clear out like all the smaller dead trees and all the stuff that's blown down. And so I'm going to be chainsawing stuff and, creating burn piles and, things like that. So, yeah, a lot of work to do. But anyway, you're not here to listen about that.
Awesome.
So let's jump into this because there's a lot to cover. So to kind of kick us off, let's start here. So the DTCC numbers are crazy. 114 trillion in assets under custody, $4.7 quadrillion dollars in transactions, 150 countries and territories, 25 billion messages processed annually, and they are tokenizing. This is massive for crypto in general. Any project that is a part of this, but what we're going to get into this episode for the first half is what this means for the projects that have been announced so far. So, not to say that things can't change. We're just going to give you the snapshot of as things sit right now, because it's important to understand details so that you can sift through the hype that you see on social media and that a lot of influencers use to try to get your engagement, get your clicks, get your likes, and things like that. Because as an investor, we need to detach ourselves from the emotion, and we need to understand that if we're investing in an asset, what part do we have in the success of that underlying company as a token holder? Are we just, holding a meme basically, or is there value capture? In memes, they have value. We've seen that with enough mind share and enough hype, there can be pumps and dumps. You can trade volatility. There's money to be made there. But as a long-term investor, you need to understand what it means to you. What part that you as a token holder, have in the success of the underlying company.
And Mike, we're not really meme coin traders all that much. We're long-term investors here at the Node.pro. And so what we focus on is our trifecta and jiu-jitsu. That's what we focus on.
I tagged you in that this morning.
I like money in the source room. That was great. Look at what he's wearing on his head, dude. Those are supposed to be peyote. Those I know. I know. So it's called peyote, those curly things that Orthodox Jews wear. Yeah. But man. So DTCC, I saw that last night, a lot of hype around CC token, a lot of hype around Canton, and a pump, nice pump too. It got all the way up to its 200-day moving average. It did reverse. It did reverse from the 200-day moving average, and that's not really all that good, the fact that it reversed away from the 200-day. But hey, you know what? I think that we're going to see a lot more trading volume on Canton. So, Mike, you see, I brought up a chart here of CC just real quick so that I can share with everyone what the performance of the token has been over the last, let's call it, 12 hours or so. So we can see here, you see I've got highlighted on the screen for everyone that 200-day moving average, that white line. So if we just take a look at that 200-day moving average, take a look at the wick. So if I zoom in even further here on this daily chart of CC token Canton, this wick, that is a big wick. So I don't know if you can really see that, but yeah, now you can see it a little bit more clearly. That's not good. So, the big pump and then giving it back. Why don't we zoom in to an hourly? So you can see on the hourly, big wicks up here, those big wicks. Now, here's the thing though. We did get a technical breakout. This is a big positive. And not only did we get the breakout, as we zoom out here, let me just fix this trend line so that it's perfect. There we go. So not only did we get the breakout, but we got the retest and it held. So you got the breakout above trendline resistance, and then you got the retest on the way back down, bouncing off of that 200-day moving average. So what that tells me is that 200-day moving average is an important level of resistance now. And if we zoom back in here and we take a look at that, there's the 200-day, comes in at 15.1 cents. And now you've got support at that trend line support, 13.6 cents. Support at 13.6 cents, resistance at 15.1 cents. We see this DTCC news really accelerate and trading volumes on Canton accelerate. Then you get closer to that BME, that burn mint equilibrium of 1.0. CC token could rip, man. That's a little bit of speculation, but the fundamentals look pretty solid. And it meets our trifecta: real user adoption and user growth. They drive real revenues, and those revenues accrue to token holders. That's the value capture that we're always talking about. Looking good.
Yeah, no, absolutely. All right. So, this is something, actually, you know what? I'm going to actually show a post, a little bit of self-promotion, but I'm going to actually show a post that I put up. Let's see. Here we go. So I posted this earlier this morning. So facts over FUD, or facts aren't FUD is more accurate. So reading past the hype of the DTCC rollout. So on today's live show that you're watching now, we are cutting straight through the market noise. This isn't about throwing shade on any project. It's about being smart, objective investors who can look past the headline hype. Let's break down the official crypto projects involved in the DTCC rollout, their actual roles, and what this means for you as the token holder. Canton Network. The reality. The network has officially launched and its rails are live and actively moving real-world assets. The token impact. Potentially bullish. Increased transaction volume on the network could drive up token burns. We're still waiting to see to what extent. However, the exact scale and direct economic benefit to its holders are still to be determined. Like I said, we're all about facts here. We do not speculate. We collect data and we paint a picture and we invest based off that picture the best we can. We don't have a crystal ball here. Nobody does. So all we can go off of is data and facts. Okay, now next, Ripple. A lot of posts out there claiming that Ripple's going live and all of this. They leave out some key, information and details. Ripple is stepping into an advisory role. The company, Ripple, not XRPL, not XRP, the company Ripple, into an advisory role and acting as a crypto key custodian. This is Ripple Prime. It has nothing to do with the XRPL. It does not use XRP. They are key custodians because of, for compliance. The token impact, it's a reputational win, neutral for tokenomics. While this is incredibly bullish for Ripple, the company, it currently offers no direct value or utility to the XRP token holders. It's important to understand that. This is what we talk about with value capture and the utility and why it's so important. Stellar. A lot of XLM, people out there posting that, Stellar's going live. The reality, Stellar is taking on an advisory role with a soft launch slated for H1, the first half of 2027. The token impact, highly speculative. How this benefits holders is completely to be determined, especially since the XLM token currently lacks a concrete value capture mechanism for this kind of enterprise rollout. Again, there is a very big difference between something that's bullish for the company and something that's bullish for us, the token holders. Can there be speculative pumps? Absolutely. Can you trade, buy the rumor, sell the news? Absolutely. But as a long-term investor, you need to understand the tokenomics, the value capture, and what these projects are actually doing. So do not just look at social media posts. So David, what are your thoughts on that?
Yeah, so as you were speaking, Mike, I was thinking about Stellar taking on an advisory role. What exactly does that mean? Advisory role. So I looked it up, and okay. First of all, we need to understand what is the DTCC, right? So the DTCC is essentially like the central plumbing for the entire U.S. financial market. So when you buy a stock or an ETF on an app like Robinhood or Fidelity, your broker doesn't actually mail in like a paper stock certificate. Instead, the DTCC clears and settles nearly all transactions in the United States. It processes, as you saw, quadrillions of dollars in value every single year. So they are the ultimate TradFi institution. So what is this launch? Well, the DTCC is launching its tokenization service. And so that means they're moving all these real world financial assets like US Treasuries, major ETFs, stocks from the Russell 1000, for example. They're moving them out of legacy databases and onto these digital rails, these blockchain networks. So this is, an RWA tokenization process. And what we're seeing now is limited production trades and live trials beginning for this tokenization effort, starting first on Canton. So what exactly does Stellar's advisory and integration role mean in this context? Well, it looks like the Stellar Development Foundation is working directly with the DTCC to evaluate legal tokenization use cases, blah, 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 blah. So basically nothing.
Well, no, I don't want to take anything away from it because, it is important, because, Ripple and Stellar, they understand the technology, they've been around for quite a while. They understand, the ecosystem and, how it all works and, things like that. So, there's value there and, they're doing good work, I'm sure. But, we need to understand that does nothing for the token holders. It's bullish that these companies are involved in that, and it gives them a lot of exposure. It gives them a lot of credibility, and credibility can go a long way to developing partnerships. And like I said, H1 of 2027, if, Stellar can make some developments and upgrades to their network so that it is better aligned for compliance for RWAs and, regulatory bodies and, all of that stuff, then, it potentially could be very bullish for the chain as well. But again, then you got to ask, but, as a token holder, does the token have value capture? And Paulo asked a very, very important question. What do you guys mean when you say value capture? And it's part of the trifecta. So we came up with this, and part of it is plagiarized. It is
plagiarized. What do you mean?
Well, it's an old school way of evaluating a company.
That's not plagiarism. We came up with this. This is an original. There's no plagiarism here.
But we took part of it. Let's see.
No. All we did was, apply, what is important in TradFi when you start to think about how do you value an asset. We're just applying this to digital assets because it can be so wishy-washy the way that you value this stuff.
No, exactly. Because, a lot of people, they just think that, that something bullish happens for the company and, automatically that means token price go up. And
It
in a
doesn't.
speculative market, in a speculative market in the past, it has. People on social media come out and they start saying that, boom, freaking XRP to $10,000, and the price starts going up. And it's because everybody starts FOMOing in. That's how retail is. They're emotional. But we need to start thinking about these assets if you want to be, a serious investor, and treat this like investments and not just, kind of a meme coin, trying to catch the next narrative. If you're looking for a long-term investment, this is how you need to start looking at it. Because for all intents and purposes, this is how TradFi investors, if you've ever watched Shark Tank, if you've ever watched, sat in a room where with VCs and investors, angel investors and stuff. I've sat in many meetings, and the questions are almost copy and paste. They always ask, what was your sales, this past year? What was your cost of production? What is your operating cost? They start asking all of those things because in their head and on their little pad of paper, they're figuring out what is your valuation? What is your company actually worth? Not what you think it's worth. What is it actually worth to me as an investor? Because what are the odds? What risk am I taking to get my initial investment back, plus any profits that I feel that I should get? And what part, if I'm giving you $500,000, how much of your company am I wanting? What share of your company am I wanting? So what we did is we took that and we added a little something extra. So actual adoption and use of the network. The way it works is, with network usage, is if it doesn't matter if it's the XRPL, it doesn't matter if it's Canton, it doesn't matter what it is it is the amount of adoption and usage. That is the product and service that is being offered. If people don't want your product or service, why would you invest in a company that nobody wants its product or service?
Yeah, people often refer to that as product market fit. So you need to see real user adoption and real user growth. If you see that, that signals product market fit. And so the stuff that you were talking about first about sales and revenue and fees, that's the next leg of the trifecta. So you start with the user adoption, user growth, and then, okay, great, you got a bunch of users. They need to be driving revenue for that protocol. And then the final leg of the trifecta here, and the most important, is value capture. So if you've got real product market fit, real user growth, real users, and they're driving real revenues for your chain or your coin or your token, well, that's great. But those revenues need to accrue to you, the token holder, in some way. You need value capture. Without the value capture, you're kind of stuck holding either like a meme coin or some type of protocol governance coin. And who wants that?
You're relying on speculative price movement, which you can make money like that. We're not saying you can't make money like that. But again, if you are looking for a long-term investment, you need to have value capture, because those are the tokens. Those are the projects that are going to be the Googles and the Microsofts and the NVIDIAs, and things like that. The rest of them, you're basically bootstrapping the liquidity for these companies to build out these products and services and build their companies out. And these aren't securities. There's no contract between you and these companies. Like, we beat up on them a lot, but XRP, there was a whole court case on it. The SEC versus Ripple. Judge Torres is the one that presided over it, and she ruled that XRP is not a security.
It was a poor decision, I think.
That means that there's no contract between Ripple, the company, and you, the retail token holder. They have no legal obligation to you for you to profit.
So Mike, the key takeaway for me from our trifecta is we need to change the way that we think about these digital assets and how we value them. Because, hey, yes, you can make money by trading some type of speculative price movement, but I would really prefer to move away from some type of emotional, speculative trading framework and move towards our trifecta, where you're looking for coins that have real value capture. That is, I think, the most important thing.
Absolutely. If anybody out there, we got about 50 people watching right now. If any of you out there have questions or comments, by all means, blow up the chat. We actually, and if you have opposing views, if you think we're full of shit, freaking tell us and explain why. Because that's why we're here. We're here to learn as well. If we get something wrong, set us straight. We're here to learn just like you are.
Hey, we cite our sources. We're here to learn. And, if you hop into our Intel library at the node.pro and you see something that you think is incorrect, tell us about it. We've got a community there we call the source room, where you can hop in there, you can paste in an Intel dossier from the library, and we can talk about it. We can talk about it live on the show. We can talk about it in the source room in the community. There's a lot of value in there.
All right. So let's jump into this. So basically, Wall Street's plumbing just went live on July 15th. Today. The DTCC, the Depository Trust and Clearing Corporation, which holds custody of 114 trillion in global assets, launched live production trading for its DTC Tokenization Service. This isn't a testnet sandbox. Under a 3-year SEC no action letter, they are tokenizing actual Russell 1000 equities, major index ETFs, and U.S. Treasury bills and bonds. The goal: instantaneous settlement, so T+0, instead of the standard T+1 delay, freeing up billions in locked margin collateral and eliminating overnight settlement drag. So break that down for us, Dave.
Well, so usually you've got T+1, T+2. Now, and what that means is settlement time. So if you're talking about settling these, TradFi assets, settling these trades, they usually don't settle instantly. In fact, none of them do. Now, the big difference between that slow settlement time, T+1, T+2, and what you get on digital rails is on digital rails, you get something called atomic settlement. And all that means is trades settle almost instantaneously. And so think about how much more quickly you can cycle capital through if you don't have to wait 24 or 48 hours for a real settlement. So settlement is nearly instantaneous. It's referred to as atomic, and it's irreversible. And so that is extremely valuable for institutions. They can cycle capital through so much more quickly now. That's a big deal.
Oh, absolutely. So let's get into the tech rails. Who's actually running the code? So many crypto projects claim they are quote unquote partnered with the DTCC, but only a few are actually providing the infrastructure rails. So the core live rails is the Hyperledger, is it BESU, B-E-S-U? It's the AppChain EVM execution engine. So it's a Hyperledger BESU. And then the Canton Network is the interbank privacy ledger. And then Circle USDC is the live settlement currency. The strategic and advisory positions, like we mentioned, Ripple Prime, which is the custody, the key vault orchestration. Stellar Foundation is the cross-chain advisory, and Ondo Finance is the on-chain collateral. Again, Ondo is another one that I'm very bullish on the project, but as we've shown.
Looks like Mike's feed might
our
be
free deep dive live on the node.pro. Oh, there we go.
I think the feed might have been cutting out there for a second, Mike. I think your Starlink out there.
I got it. I'm rewinding. So Ondo Finance. So that's when we did a deep dive on, and on our website, the node.pro, we point out very bullish on the project. I was a token holder of Ondo for a very long time until we started getting into value capture. Sold most of it, still hold a small bag, just being transparent about that. But the token lacks value capture. It's a governance token. So we, the token holders, don't necessarily benefit from that. There has been rumors that they're going to take a vote later this year, to be determined, to make it more of a utility token. But as it sits right now, it is purely a governance token. So Hyperledger BESU, that is Enterprise Ethereum. So it's an open source Java-based Ethereum client running a private proof of authority or POA consensus mechanism. How it's used: it powers the DTCC app chain. Why it matters: it gives the DTCC full EVM or Ethereum virtual machine compatibility. They run their Composer X suite on it to generate DTC tokenized entitlements, digital twins of the real world stocks and bonds. So what does that mean for TradFi?
Well, what I'm curious about here is not necessarily what it means for TradFi. I mean, obviously, it's a big upgrade, okay? So we're going from these slow, ancient TradFi rails to digital blockchain rails. So speeding everything up. But what I'm curious about here, Mike, is how does Canton integrate into all this? Because, as so we're learning about, this BSU, or this Ethereum enterprise Ethereum. So, traditional Ethereum is completely public. Anyone can use it, but that doesn't work for giant banks. They need to be able to comply with KYC AML laws. And importantly, they need to be able to shield private data. Difficult to do that on a public chain like Ethereum. So Hyperledger Besu, it acts as a bridge. So it's the same core language as Ethereum, the EVM, but it adds a heavy layer of corporate features. So you get private permission networks. That means a bank can launch its own private version of Ethereum using Besu. So they're able to control exactly who's allowed to join the network and who's allowed to view data and what data they can see. You also get this high-speed consensus that you were talking about, Mike. So instead of relying on regular crypto miners, Besu uses proof of authority consensus. So selected trusted institutions, they act as the validator set, allowing transactions to settle nearly instantaneously and practically at zero cost. That's a big deal. And there's public network capability there too. So unlike these other corporate blockchains, Besu code is fully compatible with the public Ethereum mainnet. So if a bank wants to send an asset from its private network out to the public network, Besu makes that incredibly easy. So it's like a bridge between, the requirements of these corporate TradFi institutions, privacy, stuff like that. It's a bridge between that and the public EVM mainnet. So yeah, pretty interesting, man.
No, absolutely. And so the second rail is, like I promised, Canton Network. So it's a privacy-enabled decentralized ledger network built using the DAML smart contract language. It's used, how it's going to be used. It sits parallel to the Besu app chain. Regulated banks cannot leak trade data. Canton allows banks to trade with absolute privacy. Only the transacting counterparties and the DTCC see the ledger entries, preventing front running. This is what David was just talking about. So the power players: Circle USDC, actively integrated into the working group to serve as the cash leg. You can't have T+0 settlement if you have to wait on legacy bank wires to clear the fiat side. So this is the liquidity. They're providing the liquidity layer, basically. And Ondo Finance officially debuted tokenized stocks backed directly by these new DTC tokenized entitlements. This allows Ondo to bring highly regulated, verifiable U.S. equities and treasuries into public DeFi ecosystems with the institutional backing. Again, very bullish for Ondo. But, you need to ask yourself, if you're a long-term investor, what does that mean for you, the token holder? We're going to keep drilling this in. And we're not here to influence it. If you're bullish on Ondo, by all means. Yeah, like I said, it doesn't mean you're not going to make money. It's just you need to understand the tokenomics and what it means to you, the token holder, when this bullish news happens. So, David,
there's a big difference between tech and tokenomics. So, what we're seeing here is, you've got, Hyperledger Besu. We were talking about XLM Stellar and XRPL, and now also Canton Network. And so this all relates to DTCC and their tokenization efforts, because the DTCC didn't just choose one network. I think that we're living through right now, Mike, the blockchain wars. I think that it's going to end up being very similar to what we saw in the 80s with the operating system wars and the 90s with the browser wars. So I think it's going to be, I think it's going to be winner take most. And so what we're seeing with the DTCC is that they didn't choose just one network for this tokenization push. They are building a multi-chain strategy here, and I think they're going to end up going with the very best, and they're going to leave the rest. That would be my expectation here. So when the DTCC is tokenizing U.S. Treasuries, major stocks, ETFs, these assets are designed to settle across either their Hyperledger Besu system or the Canton network. So Canton acts as this ultimate privacy-preserving connective tissue. You could think of it almost like that for institutional finance. So why, did they choose Canton? And what even is the Canton network? For anyone who's new, isn't, maybe familiar with all of the content that we've been putting out about Canton, what is Canton, right? It's a public but highly permissioned blockchain, and it's purpose-built for these heavily regulated financial institutions. So if you're going to launch a massive consortium, including, institutions like Goldman Sachs or BNP Paribas or, CBOE or even Microsoft, this is really allowing them
to get into like who's in the working group and stuff, so people have a better understanding of who it is that has a vested interest in this.
Yeah, and so these pieces all fit together. So you've got Hyperledger Besu, that's the private corporate engine where the DTCC maintains its secure internal ledgers. You've got the Canton network, which is connecting the DTCC's network directly to other giant institutional networks like Goldman or HSBC for real-time asset swapping. And then, of course, you do have Stellar XLM that hasn't gone live yet. So the DTCC is rolling out a multi-chain strategy here.
They are. Well, let me get into some of the details of what you just went over. So what's Ripple's actual role? So the XRP ledger is not the settlement rail. The public XRP ledger is not being used to settle the DTCC's live treasury or stock trades. Ripple's role is Ripple Prime. It's custody. Ripple is officially integrated into the DTCC digital launchpad through its institutional software arm, Ripple Prime, formerly Medico. If you remember, they purchased Medico and used, for the most part, liquidity from selling XRP.
Yeah, well, I mean, that's what generates the most revenue for them, is dumping XRP tokens on retail.
Yep. And that's facts. I mean, do your own research. This isn't FUD. We're just stating facts here. Don't kill the messenger. Traditional banks don't know how to securely hold private cryptographic keys. Ripple Prime provides the software vault combining MPC and HSM technology that secures the private keys to these tokenized assets. What does this mean to XRP token holders? So no, the DTCC app chain does not use XRP for gas. The transactions do not settle using the XRPL or XRP. Indirect benefit. Structurally, yes. Software dominance. It cements Ripple as a premier enterprise software provider, driving massive corporate revenue that doesn't rely on selling XRP. So it could lead, if they start making a bunch of money, maybe they'll stop dumping XRP each month. I mean, it's a thing. That's creating sell pressure. If they're every month 1 billion XRP tokens get unlocked out of the escrow, sometimes they sell, sometimes they relock. Just stating facts here. I was an XRP holder for like 5 years, and I'm very well versed on the XRP Ripple and the XRP ledger. But it could eliminate that sell pressure, so that could be bullish. Could. So once banks trust Ripple Prime to custody their private assets inside the DTCC, they are pre-onboarded. Ripple can then pitch them on bridging those assets to the public XRPL or utilizing Ripple's upcoming stablecoin RLUSD as a secondary settlement option. There's potential there. A lot of ifs, a lot of maybes, but if you're into speculation, you're into higher risk plays, not one I would take with how high of a market cap XRP already is. That's a lot of risk with very little upside. That's me personally. You do you. Just again, stating facts. So let's see here. So this is who some of the key institutional partners are in the working group. So the banks, like David was talking about just recently, JP Morgan Chase, Goldman Sachs, Citi, Bank of America, Morgan Stanley, and UBS are some of them. Asset managers, BlackRock supplying the underlying ETFs, Franklin Templeton and Vanguard. Trading and infrastructure, the NASDAQ, the New York Stock Exchange, Charles Schwab, Robinhood, Citadel Securities, and TradeWeb. Crypto platforms, Circle, Ondo, Anchorage Digital, BitGo, Hayward, which is Kraken, and Canton. And then, of course, you have Ripple Prime, Stellar Development Foundation, and Digital Asset, which is the company that created Canton Network. So, David, what other names are you seeing?
Yeah, so we've got a bunch of banks and firms in this DTCC working group. So what the DTCC did is they assembled this, you could think of it as like the top 50 elite financial firms. So you've got a bunch of mega banks, JP Morgan Chase, Citibank, Bank of America, Morgan Stanley, BNP Paribas, et cetera. You've got some asset management giants, think BlackRock, Vanguard, State Street, Franklin Templeton. You've also got liquidity and trading venues. So that's Citadel, Virtu Financial, TradeWeb, the NYSE, New York Stock Exchange. But then you've also got the digital asset, digital infrastructure partners. So that's Digital Asset. That's the creator of Canton. You've got Ripple, which is different than XRP, the token, and different than the XRP ledger. You've got Talos, and of course, you've got Circle. So these digital asset rails that are being used right now, it's a multi-chain strategy that the DTCC is rolling out. So you've got Rail A, that's the Hyperledger Besu, that's the private EVM ledger. You've got Rail B, that's the Canton network. You could think of that almost like the institutional intercom. And then you've got Rail C, that's a public interoperability bridges. That's where Stellar and XRPL fit in. But as of right now, Stellar and XRPL aren't actually being used for this. So you've got to just ask yourself,
and even if they are used, again, they're like a cheap gas token. As far as value capture, there's very little value capture there.
That's a great point. And so, Mike, I actually brought up our deep dive research in the Intel library for Stellar XLM. And, the thing that we focused on here, and look, we cite our sources, okay? So if you want to take issue with any of the conclusions that are drawn, hop on into the Intel library, scroll all the way down there to the bottom. I can go ahead and share this with everyone right here and take a look at the source documentation. And, this source documentation here, I think we need to update this, Mike, for the Stellar content here. It looks like
we did that one a while ago before I started including all the cited sources. Yeah, I'll have to rerun that.
Yeah, so what we're going to have to throw back up that source document with the sources there. But if we scroll up to the top here, the problem for both XLM and XRPL is they don't satisfy our trifecta. There is no value accrual model. And, when you take a look at what's actually running right now on Stellar XLM, it's like two companies that drive all of that transaction volume. And there's no value accrual to the XLM token. Same thing's true for XRP. So, with everything
really quick, I don't want people to think that we're just beating up on these two. This is true of like over 95% of the crypto projects and crypto tokens out there. Using this, this measuring tool, pretty much, and you're starting to see actually a lot of projects starting to adjust their tokenomics to try to give more value capture, because a lot of people are kind of catching on to this. In fact, I noticed, I was watching Discover Crypto on Monday, and I noticed that they launched a school, and they even were talking about that it's an important metric that they're highlighting in their school, because this is something we've been talking about for months and months.
They must have gotten it from us.
Maybe, who knows? But I mean, like I said, this isn't rocket science. This is something I'm surprised that hasn't been addressed years and years ago about token holders. I think everyone was just, you could throw a dart at a wall with all the logos and with your eyes closed, and whatever you hit in past bull markets, you were going to get like a 10x, 20x, 100x out of it. So I don't think people cared. But now, I mean, we're starting to move from that speculative market to a utility market where, it's not, this is what we're, going to try to do. This is what we're hoping, the pain point we're hoping to address. Now it's show me. If you can't
show me the money, prove it.
All what was it you call it? Vaporware.
That's exactly right. That's what the vast majority of these crypto coins and protocols and tokens and projects, the chains, a lot of this stuff is vapor, where there's no user adoption, no real user growth, no one actually using the product. And so that means there really aren't any revenues to speak of. And if there's no users and no revenues, then if you hold the token, what are you actually holding? You're kind of holding like a meme coin, kind of, sort of. So, we always focus on the trifecta.
Well, I mean, I always use the analogy of, you're buying the football jersey of your favorite team. You're a fan of that project because, just like it, going to if your team wins the Super Bowl, how do you benefit from that other than being like, yay, my team won? Maybe if you bet on it, and that's the same thing that you're doing by buying the token is you're betting.
I'm not here to gamble on vapor. No. I'm looking for real value accrual. I want to be able to hold something where I'm likely to perform well over time. I don't want to be gambling on some vaporware coin. So that's why we focus on the trifecta.
And if you want to do that with a small portion of your portfolio, I mean, you do it with a large portion. I don't care. But it's okay to do it with a small portion of your portfolio. If you want to put a couple of $100 into a meme coin that is getting a lot of attention, you can make money doing that. I wouldn't advise using a lot of.
It's a lottery ticket. If you want to play the lotto and some meme coins in the casino, okay, but you just got to understand that that's what you're doing.
Honestly, you might have a better chance with a lottery ticket because with 54 million different crypto tokens that are out there. And what was it? You looked at it, and it was like maybe 2,000 of them were actually real projects that were trying to build real utility. So that leaves like what 53 million, whatever.
I know, right?
It leaves a lot of fucking meme coins, out there.
Tens of millions of these coins out there that do exactly nada. And so, if you've got 50 some odd million coins, but only 2,000 legit protocols, well, then once you've got the 2,000, you've got to whittle that down further. So we've been focusing on basically the dozen or so projects out there in the digital asset space that satisfy our trifecta. There are very, very few that have real user adoption, drive real revenues, and where those revenues accrue to token holders, real value capture. So, yeah, man, I mean, most of crypto right now is, most of it's still vapor. But the cool thing is that we're starting to see these projects and protocols that satisfy the trifecta. They're really starting to perform well. And the metric that I use outside of just taking a look at the trifecta here, Mike, the metric that I use too is your coin outperforming Bitcoin? If it's outperforming Bitcoin, that is a huge vote of confidence. That's a huge thumbs up from the market.
Let's actually use the next 10, 15 minutes before we do the deep dives and kind of show, because I mean we got a lot of new faces in here. Let's actually show them what we're talking about. I mean, show the data. We'll give the receipts.
Absolutely. So here's BTC, Bitcoin. And I think that the important thing that we've got to do first and foremost is we need to understand a little bit about the Bitcoin cycle, because for whatever reason, there is a cycle that repeats for Bitcoin. You can see back in the 2017 parabola, that bull run, Bitcoin then put in a falling wedge. And the length of time that bear market lasted for was very similar to the length of time that the bear market lasted for last bear market in 2022. And what we're seeing now is that pattern repeat again. So we've got Bitcoin rallying back up above its 200-week, this is a weekly chart, rallying back up above its 200-week moving average. Now, what did it do last bear cycle? Well, in the month of July, in the midterm year, in the Bitcoin bear market year, we saw BTC last bear cycle rally above that 200-week moving average, and then it failed into the end of the summer, breaking back down below that 200-week moving average until it eventually put in its bear market trough in the early fall. It was actually November. I think that was with the blow up of scam Bankman-Fried's operation, FTX. So I think what we're looking forward to now is for this rally that we're seeing over the last couple of days here in the month of July out of Bitcoin. My expectation here is that, look, whenever someone says this time it's going to be different, I just don't think so. I think this time the pattern repeats, the cycle repeats. And so what does that mean? Well, it means that this rally out of BTC could be getting a little bit long in the tooth. You know, it's Wednesday, July 15th. It's the middle of the month. In July, in the midterm year, in a Bitcoin bear market year, we should be in like the 7th inning of this Bitcoin bear market. And so that means that if this rally continues to the upside, and if you take a look at, you know, a coin glass and you look at all the liquidity that's piled up here, all those levered shorts that are piled up, you know, up here at like 70K or so, you might see a liquidity sweep where stops get run on the upside that squeezes Bitcoin up to this level of downsloping resistance. And you've also got a confluence here. So if I grab an arrow and we just mark this, you see that 200-day moving average, how it's very close to this level of downsloping resistance, which I use the anchor point. The anchor point is the all-time high. So this level of resistance and this 200-day moving average, if Bitcoin is able to get up there, I think that's an interesting opportunity to start laying out some shorts up there, because I don't think this cycle is going to be any different than previous cycles. Now, let's take a look at some coins that have outperformed Bitcoin. Here's HYPE. So HYPE, Hyperliquid, this is the HYPE token. This one satisfies our trifecta. Real user adoption, real product market fit. Those users drive real revenues on the Hyperliquid perp stacks. And those revenues accrue to HYPE token holders in the form of buybacks and burns. So the HYPE token has performed extremely well in US dollar terms, but we've got to measure this in BTC terms. So we're going to go ahead here and HYPE BTC. Now, this is what you should be looking for. This is awesome. So amazing outperformance here. And
really quick, so people understand what they're looking at. Whenever you look at the price chart, and if you understand this, I'm sorry, but I want to make sure everyone understands. I was a military instructor, so I always talk to the person in the room that knows the least. So what this is showing is, the first chart was HYPE relative to a stable coin, or the dollar.
The dollar. Yep.
Yeah. So this is HYPE relative to Bitcoin. So this is, if you look at basically both of them trending, this is how much HYPE has outperformed Bitcoin price-wise. So go ahead.
Yeah. And so that's the important thing. So once we see that the trifecta, that all three of our points in the trifecta are met, once you see that, okay, great. But that coin needs to also be outperforming Bitcoin. And that's what we see here with HYPE. Big outperformance. And, if I were to just take a look at this pattern, this looks almost like a flag. You've got the pole and painting a flag. Now, flags, importantly, must be downsloping. And we put in a series of lower highs here. This looks almost like a flag. So a bull flag forming on HYPE in Bitcoin terms. That looks pretty darn good to me. But HYPE is not the only coin that has outperformed Bitcoin. If we take a look at, maybe something like Tron, TRX. So I know that a lot of people may not be super familiar with the Tron chain or the TRX token itself, TRX coin, but this one has been one of the best performers since 2020. So this coin, TRX, has outperformed the vast majority of digital assets out there. It put in like a 30 or 40x, and it's held on to the majority of those gains. So this is excellent. This is in US dollar terms, but we've got to measure this in Bitcoin terms. We've got to find out, is Tron outperforming Bitcoin? Yes, it is. And so we can see since May of 2024, when this chart goes up and to the right like this, what this tells you is that TRX has been outperforming BTC for basically the last 24 months. So that is a big thumbs up for TRX. Now, if I had to zoom out here and take a look at maybe another coin that has been outperforming BTC, we could take a look at Canton just real quick. Here's Canton in US dollar terms. Now, keep in mind, we have very little data here. These data only go back to November 2025. But if we go ahead and instead of measuring CC in US dollar terms, if we measure it in BTC terms, let's see here. So that's CC BTC. Let's see if I can pull up some better data. CC USD, and then I want to go CC USD / BTC USDT. There we go. So these are all the data that we've got for CC in Bitcoin terms. And although this chart is a little bit messy, notice what you can see here. If I grab an arrow tool, let me go ahead and just pull in this arrow real quick so that we can highlight this. You see that white line there? That's the 200-day moving average for Canton in Bitcoin terms. And the fact that CC, the Canton coin, rallied, bounced off of that 200-day moving average, that's good. That is bullish. Now, this pattern itself is up and to the right, and you've got a series of higher highs. So check this out. You've got a high here, a higher high, a higher high, and a slightly higher high. In addition to that, you've got a series of higher lows. So this is a clear uptrend. The definition of an uptrend is a series of higher highs and higher lows. And that's what we see here for CC in Bitcoin terms. So what we just did, Mike, is we took a look at 3 coins that have solid value capture, that satisfy our trifecta, and that are outperforming Bitcoin. So that's basically what you need to look for.
Do you mind if I point out one thing?
Sure.
So one thing to understand about Canton, again, we're going to point out the good and the bad about every project. As bullish as I am on Canton, have a very large bag of it. Just like to be fully transparent about that. But I will point out, it is still inflationary. It has great tokenomics. It has excellent value capture. The utility of the token is deeply, deeply ingrained in every aspect of it. It is probably it had the fairest launch of probably any crypto project that I've seen, but it is still currently inflationary. There is more tokens being minted. There is an infinite supply. There is more tokens being minted than are being burned. That being said, with the DTCC launch, and then in October with potentially the full launch, and with the other things that are coming on board with Zenith and launching the EVM compatible dApps and the changes that they're making with the subnets and those starting to burn Canton as well. If all of that comes to fruition, that could increase the burn and end up making Canton deflationary, but we're not there yet. You have to take emotion out of it. The tribalism, the go team, take all that out of it. Look at the facts as they are. That's the way that you're going to be successful in this. Emotion is what is used to manipulate retail, to use you as exit liquidity. So just wanted to make sure that people understand that. But despite it being inflationary, look at what it's doing.
Excellent performance.
Yeah.
Yeah. And, I think that we need to start tracking that BME every single day, that burn mint equilibrium. And also, is there any way we can get a window into the transaction volumes on Canton?
Without getting on that, what is that freaking expensive ass, like couple $1,000 a month freaking dashboard that we found?
Oh shit! You see what Jeff just posted in the chat, dude? Ostium. Uh-oh, that's not good. Ostium was one of my favorite perps dexes. They had some pretty cool products over there on Ostium, but 18 million USDC. Oof, that is that's crippling. That has to be crippling for Ostium.
Let me see if I can pull that up real quick.
I'm going to go ahead and hop on over here to DeFi Llama and take a look at Ostium. And what I see here is a TVL still sitting at 63 million. Now, if this exploit just occurred, those that may not be reflected in the TVL here over on DeFi Llama, but man, $18 million being drained from their OLP vault. That is not good, man. Not good at all. If we take a look at the website here for Ostium, I wonder if there's any mention of that. So if we take a look here at more and stats, let's see what their stats page says for Ostium.
I got the post pulled up after you're done.
Yeah, so what I'm looking for here is if I can see that exploit reflected in any of their stats. So if I go to usage, all I'm looking for is if I can see, that chart basically just goes straight down.
Yeah.
But I'm not sure exactly where those data live on here. So let's see, view collection maybe, stable coins. Yeah, I'm not quite sure. You want to bring that up, Mike?
Yeah, I'll bring this up while you look. So Ostium OLP vault exploited on Arbitrum for approximately 18 million. An attacker exploited the Ostium OLP vault on Arbitrum using a registered price upkeep forwarder and future dated authorized Oracle reports to create artificial trading profits through repeated open and close trade loops with manipulated prices, such as BTC at $5,000 for opening and $60,000 for closing, triggering an approximately 18 million USDC payout from the vault. Blockade detected the incident, after which Ostium paused all trading while investigating. The stolen funds were reportedly swapped into approximately just over 12,000 ETH. All right.
Wow, man. So, Mike, I found the OLP vault that was exploited. And so you can think of this almost like the counterparty vault, okay? So a lot of these perps dexes use a pooled liquidity model where you end up trading against a pool of liquidity rather against, another trader or against the exchange. So it looks like OLP Vault TVL, it says is sitting at $8.9 million, but I don't see that big crash in the OLP price. I don't see that in these data here. I'm assuming we're probably going to see that pretty soon here, especially if that exploit just took place. So that is not good at all. And it begs the question, like, who exactly is running the risk management team over there at Ostium Labs? Because, hey man, if you've got an 8-figure counterparty pool vault, you cannot afford to have an exploit, period. Like, they need to, this is horrible. How many of these did we see in the month of April? It was like $600 million in exploits in DeFi, in DeFi protocols in the month of April. And now we're seeing, I think it was, up until today, one of the best perps dexes to trade on, Ostium, but no longer. I mean, look, trust in crypto and DeFi, once you lose it, is very difficult to get back. So yeah, this is definitely going to negatively impact Ostium Labs for a long time.
Gotcha. All right. Well, that's the halfway mark for the show. So do you want to kick on over to some deep dives?
Yes, and just real quick, a big update shipped a couple of minutes ago to the source room community at the node.pro. If you hop on over to the node.pro, that's our official website, jump into the community tab, you'll be able to see that I did ship some pretty big updates to the way that the UI UX looks here. Now, I'm going to be shipping more updates to this today. Also, the private coaching, I think I shipped a couple of updates to this. Let's go ahead and hop into the Intel library. And we're going to start off here.
Right before you get into that, I do want to point out that on the node.pro, we have a suite of free products that you can use. If you want to learn about DeFi and crypto and advance your knowledge, free of charge, no gimmicks, no give your credit card, none of that. Just go to the node.pro. There is structured, professional, institutional grade education in there where you can learn about the traditional banking system, TradFi, fiat, crypto, DeFi, all of it, free of charge. Do not go out and pay people, hundreds, if not, thousands or tens of thousands of dollars for programs to learn this stuff. You can learn it for free right here at the node.pro. Also, David's about to show our deep dive library. We do 13 deep dives a week. They're basically snapshots. They're not all inclusive. We're not claiming they're 100% accurate, but they're like 95% accurate. And if you, like David said, if you find something wrong in any one of these, please reach out to us on the node.pro. Let us know. Cite your source. We're happy to change it. If you're correct. Now, again, these are all free, and we cite our sources. We are genuinely here to be educators and to be educated. We're here to learn as much as you are. That is why we offer these things for free, because David had to learn this stuff through trial and error and expensive mistakes. Same with me, and same with most people out there. We got sick of that. We started this channel and started this website to help you all, so you don't have to make these expensive mistakes of sending liquidity to the wrong wallet address. Stupid beginner mistakes.
They call that market tuition. You really want to avoid paying market tuition. The best way to avoid paying market tuition is to learn from a mentor who has made those mistakes already. And so that mentor, that's me. That's you, Mike. We can help people avoid making those costly mistakes. It all comes down to education. So hop into the Learn tab, run through the education here in DeFi University, the beginner education here in the DeFi High School. Once you've gone through this education, then you can hop into the Bitcoin University and learn how to start building on Bitcoin. You can hop into the Intel Library and run through all of the deep dive content that we produce every single week. Like Mike said, 13 pieces of deep dive research every single week. This stuff is all free. We give this away. How many other, crypto, channels out there charge hundreds or thousands of dollars for their courses and their educational content? We give it away. Now, if you want to give back, if you get some value, then hop into the community, the source room here, where we can chat about all of this amazing content that we publish every single day. And if you're looking for one-on-one help, you can apply to work with me one-on-one. And, it's a free 30-minute discovery call. I'd love to talk to you. Let's hop in here to the Intel.
And the best way that you can support the channel, if you find value here, is simply go down to the bottom, hit the like button, give us a subscribe, and share out the stream so that other people can benefit from all this. If you do nothing else, it take a couple seconds and do that. Thank you very much. And XS Boss, I have actually have Hecto on the slate for a deep dive tomorrow.
Yeah, I'm looking forward to it. So since we're going to start off today with, I think that this is a Canton protocol, the index protocol. Let's start off with this one. This will be interesting. I'm going to go ahead and hit play on this content.
Decentralized finance relies on scale. Billions of dollars in liquidity constantly move across the blockchain. But right now, all of that capital is heavily constrained by a core architectural limitation in how decentralized exchanges operate. Look at how traditional ETFs handle their underlying costs. Centralized fund administrators take a manual cut, usually a tiny percentage of the total assets, to cover their operating expenses and generate yield. Standard automated market makers in decentralized finance do the exact opposite. When a user makes a trade, the protocol leaves the trade fee inside the liquidity pool. Those fees automatically compound the value of the pool's reserves, directly benefiting the liquidity providers.
Okay, so not necessarily. I just want to point something out. There's a difference between full range V2 liquidity provision, where fees do compound inside the pool, and V3 or V4 concentrated liquidity provision, where fees do not compound inside of the pool.
This comparative matrix breaks down monetization mechanics across these systems. When a standard AMM retains those fees, it actively alters the ratio of assets in the reserve. That constant shifting breaks the strict capitalization weightings required to run a true index fund. To build a decentralized index fund, a protocol has to change the plumbing. It must programmatically eject those swap fees away from the active trading pool and pipe that revenue into acquiring synthetic off-chain equities. This mathematical schematic shows how the index protocol achieves its structure through a contract-driven fee interception model. Because of this sequence, the extracted fee never enters the active liquidity pool. This locks the capitalization weightings in place while simultaneously directing a continuous stream of liquid ETH straight to the protocol's treasury. At the
I
end
see.
of every epoch, the
What does
treasury
that-
initiates an
Okay, so what's going on here is the deep dive content is describing the mechanism by which fees, as a result of swaps in that index liquidity pool, are used to purchase those off-chain tokenized equities. So those fees don't accrue to the pool. Those
Okay.
fees are used to then buy those equities. So if you've got swap
So
fees,
the equities being like the tokenized assets.
correct. Yep.
Okay.
So this is just the process by which the index protocol is able to buy those tokenized equities.
Okay.
automated purchasing sequence. It takes that aggregated ETH and converts it directly into tokenized stock distributions on-chain. These distributions operate strictly as synthetic derivatives. Using peer-to-contract architecture, they give holders direct price exposure to traditional markets, though they don't carry conventional corporate voting rights. A prime target for the 2026
Oh, you know what? Index protocol is not Canton native. Index protocol is on Robinhood. This
Yeah.
is a Robinhood protocol. Yeah, Robinhood chain. Got
Good
it.
call.
Okay, so what this means though is I believe they use a Uniswap V4 pool. And the reason why V4 is so important here is the V4 pool allows them to develop a custom hook. And so you've got index token paired with ETH in a liquidity pool at that index protocol. And so when users swap their ETH into that pool, when they deposit their ETH into that pool, then some of that ETH, I think it's like a 3% cut, is used to then swap into these tokenized equity assets.
index acquisition is synthetic post-IPO SpaceX stock, traded as SSPCX. On June 12, 2026, SpaceX completed its initial public offering at $135 per share, establishing an implied market capitalization of roughly $1.75 trillion. The protocol relies on composite index oracles to aggregate live spot prices from traditional exchanges. This tracking allows the system to capture the massive influx of passive buying triggered by SpaceX's fast-tracked entry into the NASDAQ 100 benchmark. The Treasury also automatically captures other major tech equities. It acquires synthetic NVIDIA through the Synthetics peer-to-contract architecture. It pulls in synthetic Apple, backed by Ondo Global Markets and decentralized Chainlink price feeds. And it integrates synthetic Tesla by tapping into the synthetic stet pool.
Look at a young Musk.
Through this Oracle-driven pipeline, users gain fractional, 24/7 global access to traditional equities entirely on-chain, completely bypassing the barriers of legacy brokerage infrastructure. All of these synthetic assets are routed to their final destination, the dividends smart contract. To claim them, native index token holders have to navigate a strict set of structural rules engineered to prevent short-term capital extraction. First is the staking threshold. A wallet must commit a strict minimum balance of index tokens into the protocol's locked staking contract to qualify. Second, the architecture enforces time lock epochs. Those tokens have to remain locked for the entirety of a 7-day rolling window.
Okay, so I just want to point something out here real quick. A lot of times we will see protocols that generate revenue, but where the coin doesn't have any real utility in that protocol. That's not what we're seeing here. We're seeing this index coin, this index token, seems to have some real utility within the protocol tokenomics. That's important.
To activate
say
dividend eligibility.
It's a key part. It's a key part of of how all this works, because I mean, without it, the whole thing, ceases to operate.
Yeah, so you need to think to yourself, what is the utility for that token within the protocol tokenomics?
Finally, the contract runs continuous balance verification. If any withdrawal causes the staked balance to drop below that required threshold, the wallet is immediately invalidated for the active epoch. This rigorous sequence ensures that value capture scales linearly with long-term commitment.
Wow.
If stakers follow the rules, they can programmatically pull their pro rata synthetic shares directly into their own non-custodial wallets. This flowchart illustrates the macro architecture. On-chain volume is extracted as ETH, routed to the Treasury, and converted to synthetic equity for stakers.
Okay, so that on-chain volume swapped through their Uniswap V4 liquidity pool. Those fees, I think it's 3%, that is used to then swap in to these tokenized equities, these synthetics. And then it looks like you can actually pull those tokenized equities, which I think are distributed to your wallet pro rata every epoch. It looks like you can then send those tokenized equities to your EVM chain wallet. That's pretty cool, man.
But this model introduces vulnerabilities. High fee friction could trigger severe trading volume decay over time. Beyond volume decay, there is considerable technical risk. The modular routing architecture, combined with a continuous reliance on external Oracle feeds, creates a highly complex surface for smart contract vulnerabilities. Despite those operational and technical risks, the protocol executes its core mandate. By intercepting fees at the routing level and securing strict asset ratios, it successfully decentralizes the operational flow of a capitalization-weighted ETF directly on the Ethereum blockchain.
Interesting. Okay, so let's take a look at this in a little bit more detail. I want to see if I can find the index protocol, Mike, it's got to be on DeFi Llama somewhere. If I can't find it on DeFi Llama, the way that I was able to find it yesterday, and the reason why we decided to run through this piece of deep dive research today, is I started off over here on Dex Screener. And the reason why I was looking at Dex Screener is I wanted to start to familiarize myself with all of these Robinhood coins, because Robinhood, the chain, has just been blowing up in terms of volume and revenue generated. So an amazing launch for this Robinhood chain. And as I was scrolling,
I know that it did pull back recently, as far as volume and stuff, and that. But I know that in that Cash Cat, it had a pullback, but it's been doing crazy amounts of positive price action, over the past little bit, though.
Yeah. So just keep in mind, Cash Cat is a meme coin. And today off 31%. So not having a great day today. That is not good. But the cool thing here though is that this is where we found the index token. So you can see right here index. So it's index paired with USDG. And so USDG is the next deep dive piece of research that we're going to run through. And you've also got index paired with wrapped ETH and index paired with ETH. These are all Uniswap V4 liquidity pools. We're going to take a look at index paired with USDG. I'm going to go ahead and minimize this, and I just want to zoom out. So this is a 15-minute chart, and it looks like this index token is in a clear downtrend. So this is not what you're looking for. You want to see, so you've got a high here, a lower high, a lower high. You've got a low and a lower low. So this is clearly a downtrend for that index token. So where is the selling pressure coming from for this index token, I wonder? Well, let's go ahead and let's hop on into the website, right? So I want to take a look at theindex.finance. Now, we've got to start by thinking about the risks. There are a lot of risks with this protocol. So if we take a look here at, if I just scroll down, I want to see what is it that when I swap my ETH into a liquidity pool, when I deposit my ETH into the liquidity pool here, and I get pro rata shares distributed to my wallet, what shares do I get? What tokenized equities do I get? It looks like I get exposure to all, I think. It's buying, it says here, the Treasury ETH buys each supported stock in equal parts, and prices come from each asset pool. So there is a lot of counterparty risk here. There is a lot of smart contract risk here. There's oracle risk here. So if I'm depositing my ETH into that ETH index pool over here on the index.finance, and then
Well, really
a portion,
that plays into, like, right before we started doing these deep dives. Jeff posted another exploit on a DeFi protocol. I want people to understand what you're talking about. We keep seeing these issues. Because we're still very early in a lot of this tech. With Aave, we saw an issue. With Wormhole, we saw an issue. With what's some of the other, Layer Zero. Sorry, not Wormhole, Layer Zero. What are some of the other exploits that have happened recently? There's been a ton of them.
I mean, if you take a look, what was that really big perps DEX over on Solana? I used to really enjoy trading on that DEX on Solana. Let's see here. They were exploited for like $200 million. There's another one, Cetus and that's a big liquidity provision DEX on Sui, was exploited within the last 9 months, I want to say, for like a $200 million. So I'm just Drift. That's right. Drift protocol.
Drift. That's right.
Yeah.
So I mean, that's what David's talking about here is, there's a lot of potential, entry points for exploits, using smart contracts, using, different means to extract liquidity. So you just, it's okay to use, to invest in these assets. It's okay to use these protocols as long as you understand what you're investing in and where you're, depositing your liquidity. Because, we saw with the exploit when, all that, liquidity was taken from Aave, they locked it down. There was a lot of people with different wrapped versions of ETH and different, in ETH on that platform that couldn't get it off. And I don't know how it all panned out, but if it wasn't for a bunch of people stepping in and donating to kind of fill that void.
It was like the first DeFi bailout, basically.
Yeah.
They bailed out Aave. But
Go ahead.
Something that comes to mind here for this index protocol is, so you've got all these different attack vectors, right? You've got all the smart contract risk, and usually smart contracts don't get exploited for something cryptographic. The way that it usually happens is it'll be some type of economic exploit where the contract works exactly the way it was designed. And the problem is, hey, there might be a flaw in the design, in the economic model. Now, I'm just thinking to myself, why do you need to go to the index.finance and swap your ETH or deposit your ETH into a liquidity pool, and then some of that is used to buy these tokenized equities? Why do that at all? Like, why do you need to do that at all? The thing that would make sense to me is you would want to do that if this index token is consistently going up and to the right, and if the volumes in that pool are exceptionally high. That's, I think, the only reason why this would make sense. Because if you're just swapping, if you're depositing your ETH into this liquidity pool, then you're getting exposure to the index token. But if the index token goes down and to the right, if it loses value, then your liquidity pool, your deposit in that pool might lose more value than what you're able to earn in distributions, those tokenized equities. So, why wouldn't you just take your ETH and just buy these equities? Like, why do you need this complex mechanism to gain exposure to these tokenized stocks? I don't see why you actually need this.
Let's keep going with the deep dive and let's see what it has to say.
Well, it's over. We ran through it.
Okay.
Yeah. But I mean, this is the index token. So this is not what you want to see. If the index token were going up and to the right, okay, that's one thing. It's not, though. It's going down. It's losing value. So that means that if you took ETH and you deposited it into that pool, you likely have lost more value on your deposit than whatever you've gotten in terms of those tokenized equities. So I don't know, man. It's a cool idea. And the reason why we brought it up is because it's one of these assets over on the Robinhood EVM chain that is, with one of the larger market caps over here. But I'm just not convinced that you really need to go through the rigmarole of depositing into a pool, and then a portion of that is used to buy tokenized stocks, and you take all this smart contract and counterparty risk. I would just take my ETH and swap it directly for those tokenized equities. I would probably pass on the index protocol. So let's bring it on back here to the deep dive Intel library. And what we're going to do next is we're going to take a look at USDG. This is global dollar. So I guess it was launched by Paxos. I'm not all that familiar with this one, but let's take a look at this. This will be interesting. So architecting the global dollar.
Looking at this representation of the 2026 stablecoin market, you are seeing a sector with a total capitalization exceeding $318 billion, processing tens of trillions in annualized on-chain volume. Yet, despite that immense throughput, the underlying liquidity has historically been dominated by a centralized duopoly, Tether and Circle. This diagram exposes the legacy framework. Issuing entities hold the physical fiat reserves and retain 100% of the interest income, capturing the entire macroeconomic float.
Okay, so this is something that we need to just talk about for a second, because the Genius Act made it illegal for Tether or Circle or any payment stablecoin issuer to distribute that yield to token holders. So if you hold USDC or USDT or any of these payment stablecoins, by law in the United States, you cannot earn that treasury yield. So that's why we saw, those 140 institutions come together to create OUSD, because that way they can capture that yield rather than giving that entire stablecoin market and all that yield to Tether and Circle. So let's see how USDG handles this.
Meanwhile, transaction and integration costs are pushed onto the exchanges, wallets, and processors keeping the network running. That model went largely unchallenged until November 2024, when blockchain infrastructure provider Paxos launched the Global Dollar, or USDG, alongside a distribution framework called the Global Dollar Network. Rather than hoarding the reserve interest, USDG introduces three structural shifts: programmatic yield sharing to reward network participants, native Layer 2 integrations to capture retail volume, and a dual jurisdictional firewall to isolate regulatory risk. This architectural breakdown is a study in how cooperative tokenomics alters global digital asset liquidity. The defining innovation of the Global Dollar Network is its open consortium model. It distributes up to 100% of the yield generated by the reserve assets straight back to qualifying enterprise partners. We can model exactly how this redistribution works. This equation defines the aggregate yield available for the entire network. R represents the total fiat value of the reserve assets held in custody. I is the annualized weighted yield generated by those short-term U.S. Treasury bills. From that product, we subtract F, the baseline management and operational fee retained by Paxos to cover administrative overhead. The remainder is the total distributable capital. Once total yield is calculated, it passes into a second formula to determine individual partner allocation. The numerator is partner balance.
So I just want to hop in here for a second. This model looks pretty similar to what we learned about OUSD last week.
Measuring the average USDG held on their platform over a cycle, calculating their localized contribution. That localized balance is then divided by the total circulating supply of the token. By linking payouts to this exact ratio, the network aligns the financial incentives of institutions with the growth of the overall USDG supply. If an exchange maintains deep, low slippage trading pairs, their proportional balance increases, and so does their revenue share. Many of these enterprise partners then pass this yield directly down to the retail user. Kraken, for example, utilizes these consortium payouts to fund a 4.25% APY reward tier for its USDG balances, outperforming standard high-yield savings accounts. Programmatic yield distribution allows the stablecoin to function as a customer acquisition tool.
And so that is a big deal, because think about it this way. If you've got a deposit at a TradFi institution, let's say you got a deposit at Bank of America or JP Morgan Chase, how much are you earning on that deposit? If it's in your checking account, you're earning a big goose egg. If it's in a high yield savings account, you might be lucky to earn 100 basis points, 1%, maybe a little bit more than that if you're super lucky. But these stablecoin products, they're able to pass through. Now, these are rewards. The way that the legal jargon here is important. So these rewards are passed along to holders when you've got a balance on an exchange like Kraken or Coinbase. And so think about how superior this is as a financial product to a traditional banking deposit.
Me and Jeff showed a clip of Jamie Dimon last night on the show where he was like worked up into a frenzy and actually was like cursing. They had to censor him on.
I think heard that. Yeah,
like Fox Business or something like that.
Yeah,
he's like big time pissed because the influence that the banks have enjoyed, the exclusive influence that they've had in Washington, bribing, let's just call it what it is. They call it lobbying, but bribing our officials to draft legislation that benefited them. They are starting to get some W's, or some L's. They're starting to get some losses.
Yeah, we're starting to get some W's.
What's that? Yeah,
we're starting to get some W's. Yeah.
So, their Coinbase, love him or hate him, Brian Armstrong is using Coinbase's influence in Washington and it's a little bit, self-serving, because they want to attract liquidity. So they want to offer yield, for us to deposit, USDC and assets onto, their platforms so that, they have that deep liquidity to do a lot of the activities that they're trying to do. A lot of this institutional, custodial services that they're doing for the U.S. government, that they're doing for the ETFs, and all these other things. The deeper liquidity that they can have, the better it is for everybody. So to attract that, they want to give incentives, and that's why if you have USDC on Coinbase, you can earn 4, 5, sometimes 6%, which is huge. At least you're somewhat, keeping up pace with inflation. So
getting closer, you're getting closer anyway. But just think about how much better. So Coinbase, Kraken, these exchanges, for all intents and purposes, they're basically banks now. So if you have an option between keeping a US dollar denominated deposit at a TradFi institution like Bank of America or JP Morgan Chase and earning nothing on it, versus that same deposit, if you hold it on Kraken or you hold it on Coinbase, and all of a sudden you're able to earn this reward APY of 4+% and still access your money as if it were in a traditional bank account. Well, I mean, that's a no-brainer. People are going to migrate to digital rails, and we're going to see deposits flow onto these new centralized exchange banks. They're basically like digital asset banks now. So this is good.
And another service. I mean, I have Coinbase One, and I use the only card that I use now is my Coinbase One card that pays me cash back in Bitcoin. So every purchase that I make, I get like 3-4% of that purchase back in Bitcoin that just goes directly, like instantly. As soon as I swipe it at the gas pump, as soon as I swipe it at the grocery store, anytime a bill is paid, I get this little alert immediately, and it says this much Bitcoin just got deposited into your account. And so I've made probably like $400 or $500 in free Bitcoin just in the past couple of months since I started using it. So I mean, just these platforms just have superior services, and banks hate it because they're going to start losing more and more business, because what benefit is it to us to use banks? They give us nothing. They take everything. They mismanage our money to the extent of basically, going under, where they needed, they needed bailouts from the U.S. government.
And then all of the fees, like their business model is extractive.
Overdraft fees, out of network fees, it's just all these different
ATM fees.
It's ridiculous.
Yeah, monthly service charges, what the hell is that? Their entire business model is based on either holding your money in a float and not sending it immediately, so they can earn some yield on
or charging you for using it.
Or charging you for using your money, which is nonsense. So I'm very, very happy to see that these large exchanges, Coinbase, Kraken, et cetera, they're starting to really be able to outcompete these TradFi institutions for banking deposits. And that's exactly what Mr. Jamie Dimon was, hand-wringing about on national television the other day, where, he's not too happy about this. And unfortunately, they still have a ton of influence in Washington.
Yeah.
So we'll see if our representatives in Washington are able to actually represent us for a change. A little dubious of that, but we'll see.
Directly funding user rewards through the reserve interest that legacy issuers typically keep for themselves.
Right.
For those economics to function, the asset's one-to-one peg to the US dollar must be flawless. The token's creation and redemption operate on a strict mint and burn mechanism managed directly by Paxos. When an institution deposits fiat, USDG is minted. When they request a redemption, the token is permanently burned and fiat is transferred back one-to-one with zero issuance or redemption fees. The physical reserves backing this process are conservative by design. They are restricted exclusively to cash deposits and high-quality liquid assets. Specifically, the U.S. Treasury bills held in reserve are capped at an absolute maturity limit of 90 days or less, effectively eliminating duration risk and insulating the peg from sudden interest rate fluctuations. This schematic outlines the custodial architecture. Paxos utilizes DBS Bank to manage cash reserves and safekeep Treasury instruments in segregated bankruptcy remote trust accounts. The term bankruptcy remote carries specific legal weight. Under the Monetary Authority of Singapore's framework, these reserves are completely insulated. If Paxos faces corporate insolvency, general creditors have no legal claim to the assets backing the tokens.
Okay, so it mentioned Singapore there, and what you'll see oftentimes is different institutions will have legal entities in offshore. Many of these legal entities, these bankruptcy remote legal entities, they are not U.S. entities. And the reason why they're not is because this stuff isn't legal yet in the United States. We don't have that Clarity Act passed yet. So I think that once we get that Clarity Act, Mike, we'll start to see all of these institutions migrate these entities from offshore to onshore. And I hope that that means we just get better products as retail.
To verify that isolation, Paxos transitioned its independent examination services away from boutique auditing firms, moving oversight to KPMG LLP in February 2026. This upgrade subjects the reserves to a strict monthly examination cadence, operating directly under the attestation standards established by the Institute of Singapore Chartered Accountants. Combining Big Four auditing standards with legally guaranteed bankruptcy remoteness creates the risk mitigation profile required for corporate treasuries to hold the asset on their balance sheets. Secure custody provides the foundation, but a stablecoin's actual market share is determined by its distribution rails and its utility across different ecosystems. That utility accelerated in July 2026, when Robinhood launched the public mainnet of the Robinhood chain, an Ethereum virtual machine layer 2 network built on the Arbitrum platform. USDG was selected as the first stablecoin natively issued on this network. Native issuance bypasses the security risks associated with wrapped or bridged token variants, ensuring Ethereum-grade security with near-instant settlement. This flowchart maps the architecture of Robinhood Earn, operating in 4 automated stages. First, a retail investor deposits fiat US dollars, which convert to native USDG on-chain. Second, the application provisions a self-custody wallet, ensuring the client retains exclusive cryptographic control of the underlying keys.
Okay, so just because you've got control of the keys does not mean that this asset cannot be frozen or seized. So that's something to just keep in mind here. This stuff, although the custody...
We saw it recently, with USDC, USDT, with, the Aave exploit, and, a lot of the stuff that's happened is, all the, worries that we had about them coming up with a CBDC, it's, kind of quietly, it looks like that the whole time we've been using CBDCs.
Yeah, I think that, whether it's USDT or USDC or now this USDG, these look like they are almost CBDCs in disguise, or at least that they are being regulated into becoming CBDCs. There's a big difference here between holding USDC, USDT, USDG in your self-custody wallet, however, and holding a fiat deposit at a traditional banking institution. If you've got a fiat deposit at B of A or JP Morgan Chase, you don't actually own anything. And you don't have custody of that deposit. The bank does. And it's a liability on their balance sheet. So just keep in mind, when you have a deposit at a TradFi bank, you don't own anything. You don't have custody of anything. When you hold a USDC, USDT, USDG deposit in your self-custody wallet, at least you have custody of that asset. But that doesn't mean that it can't be frozen or seized. So just keep that in mind.
Third, the wallet automatically deploys those tokens into curated lending vaults powered by the decentralized Morpho protocol. Finally, borrowers access those vaults by posting over-collateralized digital assets. The interest paid streams back to retail lenders, generating variable yield averaging around 7%.
Okay, so this variable yield as a result of an activity. You see, this is really important to understand because this is how USDG is able to comply with Genius Act regulations. So what they're doing here is they are not streaming treasury yield to you, the USDG token holder. What they are doing instead, and this is what makes it compliant with the Genius Act, is they're taking that minted USDG, depositing it into a Morpho lending vault, and then what you earn as a result of that deposit in that Morpho lending vault, you earn rewards. So that legal terminology is super important. You earn rewards. Those rewards stream back to your deposit.
The systemic impact of embedding that automated pipeline directly into a layer 2 is visible in this data table from the network's launch week. Within 7 days, USDG dominated 65% of the total on-chain stablecoin supply. This required immense initial liquidity. That foundational depth was provided by a $50 million deposit from the protocol Athena, which doubled the token's volume on Uniswap. By wiring automated self-custodial DeFi routing directly into the broker's underlying infrastructure, a new asset captured the ecosystem's institutional liquidity within days. Scaling that dominance across multiple independent blockchain networks introduces an operational problem: liquidity fragmentation. Historically, moving a token to a non-native chain required a lock and mint bridge, where the original asset is held in a central honeypot. These bridges have been the target of the largest smart contract exploits in blockchain history.
Danger.
To access non-native ecosystems like Hyperliquid and Aptos without wrapper risks, Paxos integrated Layer 0's omni-chain fungible token standard. This visualization shows how it bypasses the locked honeypot entirely.
Uh-oh. So I heard a couple of red flags there. So number one, Layer 0. I wonder if they're still using Layer 0. I'd be willing to bet that Paxos migrated away from Layer 0 in favor of Chainlink instead. And then I also heard Aptos there. So Aptos is, you could think of Aptos as Sui's sister chain, makes use of that Move programming language. It was also one of the digital assets included in the SEC's Sweet 16, categorized from now until the end of time, I guess, as a real digital commodity. I don't see how Aptos is a digital commodity, but whatever. It's on the SEC Sweet 16. So yeah, Layer 0. We should probably find out if they migrated away from Layer 0.
It uses cross-chain contract calls. The tokens are permanently burned on the source chain, and the precise equivalent is minted natively on the destination chain. The global circulating supply remains unified, but the technical infrastructure routing the tokens is only as resilient as the legal framework governing the entities that issue them.
So that's a good point. And I think it speaks to what Jason Reeves posted in the chat just now. So what he's saying is, no institutions, banks, etc., they're not going to buy and hold until they've got real legal clarity here. And so we're seeing institutions start to really adopt this technology, but they're doing it with entities that are offshore. And so once we get that Clarity Act, I think we're going to see those entities move onshore to the continental United States. But yeah, it really is just a matter of these big institutions knowing what the rules of the road are And hopefully we'll get that Clarity Act passed here. I mean, I don't know. Do the people in Congress actually work? Do they ever actually show up to work? It seems like they're always on recess.
Looking at the Paxos organizational map, you see a deliberate bifurcation. The global issuance structure is divided into two distinct legal nodes. The primary issuer for non-EEA users is Paxos Digital Singapore. It operates under the Monetary Authority of Singapore.
See, this is not Paxos Digital United States of America. This is Paxos Digital Singapore because we don't have the rules of the road yet here in the USA.
Answering to strict capital and reserve mandates. The European Economic Area, however, is serviced entirely by a separate entity, Paxos Issuance Europe, based in Finland. This Finnish entity holds its own electronic money institution license and answers directly to the EU's Markets in Crypto Assets regulation. Isolating these corporate structures creates a regulatory firewall. Because custody accounts and supervisory bodies are entirely separated, a localized enforcement action in one jurisdiction cannot legally or operationally compromise the global token supply. Despite this extensive economic and regulatory engineering, the system is not invulnerable. Structural risks remain embedded within the architecture. Capturing 65% of a network stablecoin supply exposes the token to extreme concentration risk. As this architectural stack illustrates, the operation rests on three distinct points of failure. First, the liquidity deployed via Robinhood is dependent on the technical stability of the underlying Arbitrum Layer 2 consensus mechanism. Second, the cross-chain expansion relies on the integrity of the decentralized verifier networks governing the Layer 0 messaging protocol.
Uh-oh. Layer 0 messaging protocol, no good. So, this was the thing that blew up. That Layer 0 exploit is what, really messed up a lot of markets on Aave v3 a couple of months ago. Now, Arbitrum Layer 2 consensus, Arbitrum tech is used in a lot of these corporate items.
Third, the token utilizes the UUPS upgradable smart contract standard. While this allows Paxos to patch vulnerabilities, it consolidates significant control within specific multi-signature administrative roles. Roles assigned to pause transfers or execute asset protection functions allow administrators to freeze balances to comply with regulatory demands.
See, your balances can be frozen here. So, and you've also got to think there's a lot of smart contract risk here. So, just because this is being managed by a big institution does not mean that they can't get exploited. Of course they can. We see this happening all the time in crypto and DeFi. So if you're holding USDG deposits, well, your deposit can be frozen or seized. If you're holding a USDG deposit, well, there's a lot of smart contract risk. If, God forbid, something horrible were to happen, these assets potentially could be frozen, seized, or stolen. So yeah, just got to be aware of this.
This is required for enterprise compliance, but it introduces centralization vectors that separate it from decentralized alternatives. From a macroeconomic perspective, the consortial model itself faces threats. As competitive networks launch similar payout structures, the market may enter a phase of yield wars, compressing margins for issuers across the board.
Right. So who's the big competitor here? OUSD. It's OUSD. Very similar.
The movement toward cooperative, partner-centric revenue models presents an alternative to legacy extraction, testing whether issuers can sustain growth while sharing a portion of the float they help generate.
And so that extraction, those competitors with extraction that they were talking about, that's Tether and Circle. They're the ones who earn that treasury yield and are not able by law to pass that along to token holders.
And
so
I'm sure they're all broken up about it. They're probably using like all their money to dry their tears. Because they're not able to share that all those profits with anybody that's holding the token.
Yeah, but hey, you know what? We've seen USDT and USDC depeg in the past. Those tokens have depegged. So yeah, just keep that in mind. That
and whatever happened with that fucking audit that was supposed to be going on with USDT? Like there was supposed to be this huge audit that's going on, and they were all busy doing this audit, and then it was like crickets. Like what the
audit?
What the hell?
What audit? What are you talking about? Audit?
Right? right? It's like, what's this on? Hey,
Hey, no, look over there. It's a Wookiee.
it's a Wookiee. It's a Chewbacca. Chewbacca is, a Wookiee from Endor.
It'd be about 350.
While
Yeah.
smart contract and concentration risks remain, the combination of programmable yield sharing and dual jurisdictional legal firewalls offers a structural template for the integration of digital currencies with traditional finance.
Okay, so that was a great piece of content. If anyone is looking for a follow-up piece of content to that, I would recommend that you hop into the Intel library and type in OUSD. So OUSD, this is a stablecoin product that is competing with USDG. It has a very similar architecture where that yield streams to the institutions that mint this token and use it to settle transactions globally. So USDG is not the only game in town that's doing that. OUSD is doing it too.
Well, and if you look at who it is that's launching OUSD, it's all the banks. So,
Right.
of course, the yield funnels back to them.
Yeah, all your base are belong to us. Yeah, man.
Yeah.
So I mean, so OUSD, this one, I mean, if I had to bet, if I were a betting man, and I am, then I would bet that OUSD will be able to outcompete USDG simply because of the institutions that are backing OUSD.
It's all the major banks. They're the ones launching it because they're fighting crypto. They understand that they lost the battle, that it's getting adopted, and they are coming up with products that they control because it's all about control and profits. They're coming up with products that they control, that they get the yield, that they make the money, just like they always have. They're not going to give up without a fight.
And so, one thing that's really cool, Mike, about the Node.pro and our community, the source room, is that you can share any piece of deep dive research here directly to the source room. So if I want to talk about OUSD and say something like, I think this OUSD product may be able to outcompete USDG, well, I can go ahead and post this in the chat here, and we can start a conversation about OUSD, compare it to USDG. And what I'm going to be doing here throughout the rest of the day today, Mike, is I'm going to be significantly just continuing to upgrade this source room chat so that it is, easier for us to consume content on here, share content, and that way we can see everything in one place.
When we just launched this, like a couple of days ago, and there's already like 50 people in there.
Yeah, take a look at the members, man. Like everyone's signing up. It's so cool to see. If I just zoom out here. So yeah, this is the source room chat. And I'm just going to make this easier to read. That's really what I've been focused on here is making it easier to read. You can see everyone who's joined so far. We've got like 50 people that have joined so far. Really, really cool to see that adoption so quickly. But I'm going to make it easier to read. Now on mobile, it looks a hell of a lot better on your mobile phone now. So for anyone who's using the community source room on their mobile devices, it's pretty cool over there. But if you want to have a chat about any of the content in the Intel library, well, hop on into the community source room. That's the place to do it. And if you want to build a skill set in crypto and DeFi for free, without paying for some course or paying for some community, like we give this away, man. Like there's no excuse for you, if anyone's watching this and looking to build a crypto and DeFi skill set, the only thing that you need is to want it. You just got to want it for yourself. If you do, well, hop on in here, hop into the DeFi University. Maybe you start off by learning about concentrated liquidity provision. Maybe you want to learn about automated market maker fundamentals. Great. There are quizzes in here too. So tests on learning. This stuff is extremely valuable. I wrote books on all of these topics. They're published on Amazon if you want to support us there. And you know what? This stuff is all free. We give it away. And if you want to talk about the lessons in the DeFi University within the community source room, you can do that too. If you click on this little plus button, you can attach Intel. You can also attach lessons. So this is really, really cool.
Like if you were going through it and you don't feel like that it explained, something, enough, and you want to ask me or David or somebody else, like a mentor in the community, you can actually post the module and say, hey, I was going through this module, and maybe, hey, this is incorrect, or I didn't understand this. Can you help explain it to me? And we're more than happy to help you. Again, we genuinely are here to educate. We're here to help you all avoid the mistakes that we made having to learn this stuff, because was nobody out there, and there still is nobody out there that I've found other than us that's willing to teach this stuff without charging. We're giving this stuff away because we genuinely just want to help you be successful, in crypto and in DeFi.
Yeah, and check this out. So what I did is I just pulled up lesson 1 in the DeFi Money Markets course in the DeFi University here at the Node.pro. I attached it to a post, and all I'm saying is, let's talk about how yield accrues to these DeFi money market vaults. And I post it, and bada bing, bada boom, there we go. So this is pretty cool, man. I'm going to make this much better today, though. I'm going to be shipping some updates. I think I'm going to do that live during the 4 p.m. call, the daily market wrap. Awesome.
The server, the source node is on. Is that in your charge? Not sure what you mean, Twinklebell.
The server, the source node. So this is all at the Node.pro, Twinklebell. Yep.
Yeah.
All at the Node.pro.
Yeah. Just go to the Node. Top center of the screen, the Node.pro. That's the website. Again, we don't ask for a credit card. We don't charge for anything. Just go in there and use the resources. But this is some somewhat breaking news. Want to make sure any of you out there that are invested in Moonwell. Important notice: Moonwell on Moonbeam. So Moonbeam Network has announced that the Moonbeam Network on Polkadot will sunset, which means it's going to shut down July 31st of 2026. So the last day of this month. If you use Moonwell on Moonbeam, action is needed. Assets and positions remaining on chain after this date may no longer be accessible. To support an orderly wind down, risk manager, this risk manager here, whatever labs, will recommend accelerated collateral factor reductions for Moonwell Moonbeam markets in this month's parameter recommendations. Well holders on Moonbeam should transfer their tokens to the base network, Optimism, or Ethereum mainnet before July 31st. To transfer well between networks, visit moonwell.fi/transfer. More information is available here. Migrate portal Moonbeam. So, I'll post this in our community on the node.net. If you're interested in finding that.
So Mike, how many of these chains and protocols have we seen? We've seen so many of them sunset. They're basically, go away.
And that's another one that's on Polkadot. Polkadot is.
What does that do again? We ran through deep dive research on that. I still can't figure out exactly what it is that they're supposed to be doing.
All right, so there we go. We're freaking in the general. I just posted that. So if you're looking for that and you want to, loving how this is looking, David. This is exactly what I was talking about. Where
isn't that cool?
It's easier to see and read everything. This is fucking beautiful.
I know, man. It's just going to get better and better. So this is, I spent the morning session. So the morning session for me is usually like 7 a.m. to noon. And I spent that session really shipping some updates to the source room community.
And so, if you're invested in Moonwell and you're interested in the details, I posted it in here. So a couple of things that we have changed. I just since we have a couple of minutes, I want to go over this. We made some changes to the Node network. So I moved the red pill. So if you're, we're very based here. If you're into based content,
based as fuck, boy.
Yeah, I moved over to another channel. It's our old channel, our old DeFi crypto and airdrops. It's called Unfiltered and Sovereign. So the red pill Thursday nights. It's basically where we get drunk and we debate.
No, we don't do that.
we get, debate hot button issues. So it might be the war in the Middle East. It might be the use of psychedelics as medicine. It could be what it means to be a man, dating, modern dating, what it means to be a good father and husband. We go over like just pretty much anything and everything. And then also I have sovereign soil. So I am a retired military member, did Army and Marines for 22 years, retired about just over 10 years ago, sold everything, moved up into the woods, lived in a tent, built the cabin you see behind me. So I'm a homesteader. I've been in emergency preparedness for over 20 years, and I share my experience, with all of that. And then also, I am starting an adventure guide company to where we do hunting, fishing, overnight hiking and camping trips, kayak and kayak camping, all of that. I'm actually going to start this weekend. We just purchased a property. I'm going to start clearing that and start building it out. So I'm going to be documenting that and sharing it. So if you're, kind of into that kind of thing, that you might want to check that out. And then Jeff, just posted, he's the third owner of the Node.pro and the Node. He is moving all of his music and DJing stuff, and I will add this to our brother channels here on the network as soon as we end the stream, Jeff. But if you're into DJ music, if you're into the AI music that David and Jeff have been generating, that's all being moved over to the link that Jeff is posting. And maybe we can like put that on the website, the Node.pro somewhere.
Oh yeah.
Just have like maybe like a logo, just kind of like how we have, here on the YouTube.
100%.
Just have something simple like that. I don't know. We'll figure it out.
Oh yeah.
So now we've thought about doing an Airbnb. But really what it's going to be is we're going to have it's about 30 acres. So we're going to be doing a lodge, like a main lodge that is going to have like a big kitchen, like a big common area, big kitchen, a big living room area, big screen TVs, basically like a giant man cave. And we're going to have dry saunas, cold plunges. We're going to have there's already an old 3-story cabin that we were thinking about renovating. And we decided we're actually just going to keep it as it is and make it a close quarters combat. So we're going to buy a bunch of airsoft guns. So we're going to get a bunch of AR airsoft guns. And so basically people can come up there to do like man retreats, like bachelor parties, corporate retreats, whatever. And you can come up there and I'll teach tactics. So, all my military training and stuff, and maybe I'll have some buddies come up, but basically teach you how to clear rooms and then let you just have battles.
That's going to be awesome, Mike. That's going to be so cool, dude.
Well, there's like thousands of acres, tens of thousands of acres of national forest around too. And you can get the biodegradable pellets, and we'll have 4-wheelers and snowmobiles and stuff too. So basically we'll do like scenarios, have different like pre-built scenarios, like hostage situations and whatever. And people can just have a heyday, come up there, drink bourbon, smoke cigars, shoot each other all day, do cold plunges and, saunas, just do man stuff. So yeah, it's going to be pretty cool.
Dude, I can't wait. That's going to be awesome. Yeah. Oh, man.
So yeah, no, my brother Taylor, he's on the red pill all the time. He's a practicing lawyer. He owns a couple of law firms down in McKinney, Texas, a couple of title companies. And, basically his son graduated high school and his son wanted to build something like this. And they come up here all the time and fell in love with the area. And so, basically he's like, let's do this. And so we bought the property, we're, building it all out. And me and his son are going to run it. And it's just going to be a place that he can come up and play, I guess, whenever he's not running his companies. So yeah, pretty excited.
That's so awesome, man. And I was thinking too that that source room, like social network app that I've been building into the Node.pro, what I could do with that thing is I can clone it, turn it into a standalone app, and then it could be, something that you use with your new company there to chat about whatever it is that you want to chat about. That could be pretty cool.
Absolutely. So yeah, a lot of changes, coming to the channel here. Like I said, we're separating everything out. It just works better for the analytics, I guess, for YouTube, full transparency. So yeah, appreciate you all. Appreciate your support. If you could, on the way out, please smash the like. It is the cheapest, it's the free, awesome way that you can help support the channel to get the word out there so that we can help other people, help educate other people, and prevent them from getting taken advantage of by a lot of other people out there that are trying to sell the stuff that we give away. So with that, thank you, David. Thank you all. Thanks, Jeff, and all of you in the chat. And until next time, Veteran Crypto out.
Peace.